Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Today I'm pleased that we have Jack Crooks with us. Jack will be talking about U.S. dollar forecasts, what's driving the global markets. Jack's been with us many, many times, and he is the expert in the fundamentals of the currency markets, at least as it pertains to the ISE. I always look forward to listening to Jack and having Jack talk about his insight into currency markets, what's happening with the dollar. So without further ado, I want to introduce Jack Crooks, president of Black Swan Capital. Hey, Jack, how are you?
Hey, Steve. Fine. Thank you. Appreciate it. Steve said we're going to go through the dollar forecast title of this, dollar forecast, or we could call it our dollar guess, so to speak. I think often when you use the word forecast in currency markets, it sounds quite official. But the reality is the market's been moving very, very quickly, and the dynamics, not only the technicals, but obviously the fundamentals have been moving very, very fast. Often we hang our hat on a fundamental, but they can be as ephemeral, change as quickly often as the technicals. So often I tell John Ross, when we use the word forecast, it almost sounds like we have a crystal ball. We don't, but we do see some things shaping up a little differently than others out there, and hopefully we can spark some ideas in your head. And as Steve said earlier, just please type in your questions. I do enjoy your questions. They are excellent, and it forces us to think on this side of the fence, that's for sure. There's our disclaimer. There's the ISE disclaimer for options. And this is a list of the option pairs that are offered on the ISE. As you can see, they offer them a couple different ways on the ISE. They slice them and dice them however you'd like them. But the beauty of it is you get access to not only all the major currencies in the world, the 7 major, the 6 major pairs, but you also have access to Mexican peso, New Zealand dollar, Swedish krone, and Brazilian real. So it gives you really a great mix of currencies from really all around the world. And if you see something that's hot in any particular region, you can sure access it here if you can any place. I don't know of the other exchanges that offer these this many, and also in such variety in terms of style and what you want quoted first or second. The beauty that we see, we don't use these as much anymore, but we've used them in the past. We think these are very, very good for people that want to play an intermediate term move in a currency, don't want to go into the spot Forex market and take that type of risk and be disciplined with a stop, don't want to go into the futures market and have to worry about, again, putting stops and big moves, and, where you can keep it very, very simple using this product. And this is the way we like to use it, is just buying a put or buying a call, making an intermediate term directional bet, and you know exactly what your risk is. It's your cost of buying that put or buying that call, but it's a very, very heavy leverage bet that if you get it right is going to pay off very, very nicely, much more than it would in trading just a simple ETF or exchange traded fund. Not that they're bad products, that's a good product, but if you want a little more action, and when you get it right and you want to be paid, this is a great product for that. And I think that's the way most of the retail investors should use this product. Now, you can do anything you want, and Steve's the expert. I know very little about options other than what a put and what a call is, to tell you the truth. Steve knows all the strategies, and if you ever have any questions on various strategies, you can do any of the strategies you do in the stock market and stock options. You can do it here. The only difference is the underlying, and the only difference is that the underlying, the currency tends to trade a little differently than the other asset classes. Again, very similar, driven by fundamentals, driven by technicals, but same token, you tend to get more, I would say, sentiment-driven trends, and you get a lot of false rationales in currency markets, which leads to over and undershoot. which is a good thing. If you're trading them, you can, hopefully ride and continue to ride a trend, even if the rationale is wrong. If they keep pouring money into the trend, it gets going. And the reason I say you get a lot of false rationales in currency markets is because there's just so many different rationales that people latch on to. The ultimate driver is money flow. That's obviously, the money flow is driven by what we think are fundamental events, but sometimes the headline fundamental events are only a part of the story. There's a lot of portfolio positioning, a lot of risk on, risk off stuff, and a lot of different correlations that are come into play in the currency markets that may be the ultimate driver, and we think it's something else, and that's what I meant by false rationales. You tend to get cleaner reasonings and rationales in the other markets because you have cash flows, dividends, management, all types of things you can evaluate in other markets, but you don't get that in currencies. So I think this is a great way to go ahead and play that if you don't want to have the discipline to put your risk in and put your stops in and be very, very focused, that you would need to be more in the Forex and futures market. So that's why I like this product very much. Okay. I've shown this before, and I just wanted to show it again. I would say, and we continue to say, John Ross and I, my son is John Ross, does a lot of research here. We continue to think that this global rebalancing, as old as a theme as it sounds, as worn out as it sounds, really is the key driver still in these markets going on. And if you've seen this before, I don't want to bore you, but for those that haven't, I'll go through it quickly, just to show you again, just to try and give you a definition of what this global rebalancing stuff is, and also to show you that there's global rebalancing on different levels. For example, let me go through this chart. Overconsumption is being rebalanced against overproduction. Overconsumption countries are the current account, CA stands for current account, those deficit nations, and CA, the surplus nations. United States is the poster child for the big current account deficit nation. They have, obviously we know what that means. They have trade deficits with their primary rival, China, who's the poster child for overproduction and a massive surplus nation. So that's the major rebalancing act going on in the world between China and the U.S. But you also have it going on actually on a mini basis in Europe. Germany's playing the role of the overproduction current account surplus nation, and the rest of the countries, to a large degree, especially the southern European nations, the ones that are in trouble, play that idea of the overconsumption. Overconsumption in their part is they take all the German goods. Germany basically has a captive market in Europe to ship goods to, and that's one of the reasons they got into the euro and gave up their D-mark. It created this captive market for them so they could be the wealth driver and sell all this stuff to all these guys on the left side in the Eurozone. We know the names now, Ireland, Portugal, Spain, Italy, and the like, the countries that are in a lot of trouble. So that game is playing out internally. If you had to look on a global basis, the two major, I guess you could say, drivers of current account surplus are these guys. China, number one, Germany, number two, in terms of the biggest exporters in the world. And they primarily, the primary demand source is still the United States. The problem is the rest of the Eurozone, the demand is falling by the wayside, and the U.S. is playing that role more and more, even though its own consumer has fallen off the cliff a bit in the U.S., as we all know. The U.S. is still taking on most of these exports from China. You visualize that in the large current account deficit still run by the U.S. against China. China's surplus, global surplus, is about 140%, 150% level, I think, now against the U.S. What that means is it may be running a current account deficit against all of its other trade nations, combined, but with the U.S., it provides most of its trade surplus globally.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.